I've traded the US market for over 10 years. And there's one thing I know for sure. In the market, it's not complex strategies that survive. It's strategy with clear rules. Most people trade range like this. They draw a simple box, top and bottom, and jump in here and here. And what happens? You just keep getting stopped out. That's not a skill issue. Your criteria are wrong. What I'm about to show you today is completely different from the usual box range trading everyone uses. It's a box trading strategy built around specific moments when volume explodes, and the logic almost stupidly simple. With just this one rule, this moment the market opens, you will instantly know, is this a buy zone or do I stay the hell away from this? The more some people trade, the more money they actually lose. Sounds strange. They study more, but somehow their results got worse. Most of these people do the exact same thing. They start staking complicated indicators on their charts one by one. RSI, MACD, Bollinger Bands, then another indicators. Trend lines, support and resistance, formulas, settings, complex concept on the top of that. At that point, the chart is a mess. You can't even tell what you are looking at anymore. And that's not even the end of the problem. There's a clear pattern here. Everything is too complex, not one standard, but way too many. Every situation changes the entry. Targets change, stops change. So every time you try to enter, your brain just explodes. The strategy I'm about to show you is the complete opposite of that. It's extremely basic, ridiculously simple. No indicators, no complex interpretation. And yet, with this exact strategy, I'm closing over $100,000 in profit per day. In today's video, I'll break down 3 things: how to use this strategy, why it works this way, and my real-life trades step by step. Watch this video till the end, and you will understand why in trading, it's not complex strategies, but simple ones that survive the longest. No matter which market you trade, it honestly doesn't matter that much. Stocks, futures, Nasdaq, or any other asset. What I'm talking about today isn't price, it's time. The time when money moves stays almost the same no matter the market. Including futures, the Nasdaq trades about 23 hours a day. Within that, you've got the Asian session, European session, and US session. Today, we are going to focus specifically on the US market. This time window is when the largest wave of orders hits the market at once during the day. So, when you start trading, the very first step is dead simple. Open the 1-hour chart and draw a box around the single candle where the US market opens and closes. You take the high and the low of that candle, just those two, and wrap them into a box. So on this chart, the box you are seeing captures the price action 30 minutes before and after the US market opens, all bundled into one clean range. That's where the obvious question comes up. Why draw the box, specifically on the US open candle? Because this is the moment when the most volume and the highest volatility explode at once. Most institutions around the world build their positions right in this window. Let me give you an example. Say during the first hour of the US session, price drops all the way to the bottom of the box, then gets pushed back up to the top of the box. To move a price like that takes astronomical amounts of money. That means this zone is where massive buying and selling pressure collided head-on. When you look at it through this box, the top of the box marks the price level where selling pressure was strongest in that window. The bottom of the box marks where aggressive buying actually stepped in. And there's one more key concept here, the midline of the box, the 50% level. This price is where buyers and sellers fought the hardest and stay balanced. It's the true center of power. That's why the market reacts around this structure if price holds above the midline. Buyers are in control. If price gets rejected below the midline, sellers had the edge. The box structure is simple. Top is strong resistance, bottom is solid support, and the middle is the decision line that reflects direction. All three are formed within that single 1-hour US opening candle. Let me show you how this works in real trading. This strategy is most effective after the US 1-hour candle closes and during the first 2 hours that follow. Let's draw the US open box on this chart. Now extend it forward. From there, you drop down to lower time frames and look for precise entries inside this zone. When you drop down to the 5-minute chart, you will see the US opening candle closed bullish, which means price is currently holding above the midline. About 20 minutes after the opening candle close, you can see a doji forming right at the top of the box. So, what do we do here? Sell, right? Let's see what happened next. Price pulls back again, but that doesn't mean the trend fully flipped bearish. It simply hit the strongest resistance in that zone and react. Breaking the top of this box takes serious buying power. Why? Because even when the US session opened, when the most money rushed in, this level still didn't break. Most beginners panic here and think the trend just flipped, so they cut the trade. But watch what happens when price comes back down toward the midline. You see long lower wicks forming as price pushes back up. And just like that, it rebounds all the way to the top of the box again. Let's look at another chart. Remember, what's the very first thing you do? You find the US opening candle. Then connect its high and low to build the box. Since we are trading inside this structure, stretch the box forward as far as possible. Now drop down to the 5-minute chart. You will see price push up toward the midline, then get reject, leaving a wick and rolling back down. And from there, price drops again, all the way back down to the bottom of the box. What happens next? Price finds support at the bottom of the box, pushes back up, then gets reject at the middle line and rolls over again. It works the same on any market. I showed you Nasdaq here, but gold, Bitcoin, Forex pairs, the behavior is exactly the same. Charts are just the raw results of real orders. Human psychology and behavior playing out in real time. That's why this works no matter which market you trade. Let's look at this chart. Same process. Draw the box on the US opening candle. Now drop down to the 5-minute chart. You will see price is currently holding above the midline. Price breaks below the midline, then prints a long lower wick right at the bottom of the box. That's your signal. This is where you can step into a wrong position. What happens next? Price pushes up to the midline, gets reject and drops. Then down at the bottom of the box, you start seeing multiple candles with long lower wicks staking up. That's support forming. And from there, price rips back up. And this pattern just keeps repeating. Now, then you understand the US opening candle box, this chart suddenly makes sense. You can anticipate these moves. But let me ask you this. What if we erase the box? How does it look now? Do you honestly know where you are supposed to trade? We buy when we see long lower wicks forming at the bottom of the box, but other traders, all they see is strong downside momentum, so they jump in short. Or because one thing is missing, that box. So should you short it here? Without the box, price looks like it is for forever. That's how people end up chasing sales. And I'll be clear, trading by chasing price is something I never recommend. Until real power shows up, strong enough buyers or sellers to break this box, price will keep rotating inside the range. That's where we trade. Defined range, clear reactions, Once you understand this, trading gets a whole lot easier. Now, let's flip the perspective. What happens if this box gets broken? I told you if a reversal candle forms and closes at the top of the box, you look for a trade. But this time, price pushes straight through the box. So what do you do in that case? A breakout like this means one thing. Huge buy or selling pressure just absorbed all the earlier US session liquidity. Should you chase it and jump in? Absolutely not. I just told you. That's not the move. The high probability entry comes when price pulls back to the box. That's where you trade it safely. Let's look at this chart. Draw the box. The US opening candle and extended forward. Now drop down to the 5-minute chart. At first, price gets rejected at the top of the box. Then, on the next move, it breaks clean through the upper boundary. That's not where you enter. You wait for the pullback. Then price pulls back right to the top of the box. It closes with a wrong lower wick. That's your signal. That's where you enter. Why do we enter here? Because breaking the top of this box means price just crushed a major resistance level. This isn't random. It's a key price zone built by US session volume. And at the exact level, buyers completely overwhelmed sellers. So when price comes back to that level, the odds are high that the winning buyers will define it again. What if it doesn't pull back and just keeps ripping higher? Let it go. Miss it on purpose. Like I said earlier, as a beginner, avoid chasing entries at all costs. Let's look at this chart. Draw the box around the first hour of the US session, then extend it forward. This time, price breaks below the bottom of the box, a clean break. Then it comes back up and retests the box bottom. That pullback. That's your short entry. This box strategy is so effective that you mark the first hour US open candle. Then drop down to lower time frames, 1 minute, 5 minutes, and you will keep getting entries. They don't run out. Take a look at this day. On the 5-minute chart, notice how many times price keeps coming back to the box. And just to be clear, all of this happened within a single day. Draw the box on the US opening candle, then drop down to the 5-minute chart. Right after that opening candle closes, you can see price getting supported at the bottom of the box and pushing up. Then it rallies to the top of the box, gets rejected, and after that, it breaks through the top again. And only after the breakout, price pulls back to the top of the box, prints a doji, then continue higher. Just training the reaction around this box gives you more than enough opportunities to pull solid profits all day long. For those who still don't fully get this, let me show you exactly how to apply it in real trading, step by step. We are going to trade gold. Stocks, commodities, crypto, it all works the same. Repeat this exact process and you will naturally start repeating profitable trades. Let's start from right here. The US opening candle has just closed. Now, I'm drawing the box on that complete US hourly candle. Now, let's drop down to the 5-minute chart and look at the current price. In this situation, what position should you take? Nothing. There is nothing to do. Price is above the midline, but it hasn't touched the top, and it hasn't retested the midline either. If price closes with a candle showing the rally start at the top of the box, I will take a short position. But if it breaks through the top and closes above, I will wait and take a wrong entry when it pulls back to the top of the box. Let's watch and see. Alright, the opening candle broke above the top and closed. As I explained earlier, I'm not thinking about shorting now. But I'm also not chasing a wrong entry immediately. I'll wait until this candle pulls back to the top of the box and shows signs of rejection. Price has now pulled back to the top of the box. As I said earlier, this is where I take a wrong entry. Once the candle closes at the box top, I enter. Let me mark my entry on TradingView. I went in at 4337. Now, let's use the opening candle box to set stop loss and take profit levels. For the take profit, I basically target a move equal to the height of the box. That's my minimum target. If the trend is strong, an ongoing uptrend, I'll extend the target to 1 time, 2 times, even 3 times the box height. I set risk reward based on 1 box, 2 boxes, 1 to 1, 1 to 2. Here, yesterday's US high aligns with the top of the second box. So, I will set my take profit at the second box top. The top of the second box is 4374. I will set my take profit there. On this chart, the first dotted line is my entry. The second line is my initial target. The third line is the final target I'm actually aiming for. Stop loss will be triggered if price hits the bottom of the US opening candle box. Vertically, the take profit is 4374 and the stop loss is 4320. The key point here, I entered exactly according to the rules I set. Even if price drops back below the bottom of the opening candle box and triggers my stop loss, that's perfectly fine. Because I'm simply trading by the rules. If it hits the take profit with a 1 to 2 risk reward, that's 37 points, or roughly $3,700 in profit. Price has now reached the first target. Current position is showing about $150.44 in profit. Here's the point I really want to emphasize. If I were a trader who rocks in profit quickly, I could close the position here, or I could take half off and hold the rest. But my target is the top of the second box, so I will continue holding. Price is pausing a bit right now. There are still about 2 hours until the US session closes. I've already closed the position on my other account. The position I'm showing now, I'll continue to hold. Since I've reduced the size, I'll take it overnight and see how it plays out. Alright, the Asian session has started and 3 hours have passed. Price has now done exactly what I was targeting. It reached the top of the second box. Yesterday, price lingered around the middle line of the second box. Then, at Friday's US close, it pulled back to the top of the opening candle box. On Monday, during the Asian session, it found support at the top of the first box and pushed it higher. If this price action had happened earlier Friday in the US session, I would have added my position. But since this was an overnight trade, and I wasn't watching during the Asian session, I did not get in. I took $36.27 in profit from this single trade. That's the power of the US opening candle box in action. By now, you've got the full picture. To summarize, draw a box on the US opening candle. Of course, you don't trade during the first hour. You have to wait the candle to close to draw the box. Then, if price reaches the top of the box and a store candle forms, you short. If it drops to the bottom of the box, think wrong. And if price breaks through the box, do not enter immediately. Wait for at least one pullback, then enter in the direction of the move at the top of the box. Take this box theory and try it in your own trading. Then drop a comment with your results. I want to see how it works for you. Once we hit 2026 comments, I will release part 2 with an even more advanced strategy. I will analyze a full year of opening candle boxes and share it. Thanks everyone.